According to data from Dealogic, shares of technology startups and other companies that went public in the U.S. this year are trading roughly 5% above their offering price on average. Yes, that's positive, but it is far short of the S&P 500's nearly 18% jump. Let's take a look now at some of the worst and most notable debuts of the year. Smile Direct down 34%. Uber, we mentioned it, 33% down from its IPO. Lyft, Peloton, Slack, and I guess the real looks pretty good, being down only 1% from its IPO price. Joining us now to talk more about this is Arash Massoudi. He is corporate finance and deals editor at the Financial Times, and he joins us this morning. Arash, great piece. So for our viewers who, couldn't read it, and shame on them, but they couldn't read it, what is the overall takeaway between the IPO market and maybe the macro market in general?
Well, I think what we're seeing is something that is quite strange, right? These companies that are IPOing are supposed to be the most interesting, hottest companies in the global economy, and when they come to market, it's supposed to be this opportunity for investors of all shapes and sizes to get their hands on them. And what you're seeing is the public markets, which are supposed to accept this product, which is brought to them by investment banks, with open arms, fundamentally reject them. And the stuff you showed on the screen just now doesn't even capture the worst one of all, which was WeWork, which wasn't just a rejection of the IPO, which they had to pull. It was a fundamental rejection of the concept, the valuation, everything that went along with it. And so what you're seeing is the ones you showed on the screen there, down Uber, Lyft, Peloton, Slack. These are supposed to be the kind of most exciting new companies in our economy. And at the same time, they're not performing anywhere near what their shareholders would have wanted them to do when they listed. And what's happened is basically the private markets have sucked out all of the juice there are in these companies, and they're coming to the public markets at a valuation that investors just fundamentally are rejecting. And so this distortion between the pull and push and pull between the buy side and the sell side is really playing out in these last few weeks. And how that ties into the macroeconomy is, as you pointed out, the S&P 500 and some of these other more normal companies are performing totally fine with respect to share prices. So you're seeing the kind of exciting companies having been overhyped and being rejected, and some of the more sort of run-of-the-mill companies that we're all familiar with doing much better.
Yeah, is there necessarily a reason why you guys have dug, when you dig into this, Arash, is there a reason why these IPOs have done so poorly? Is it just that investors don't like the stock, or the viewpoint that the private markets extracted most of the gains beforehand, or the bankers screwed up in initially pricing it?
Yeah, I mean, if you want to look at the IPO market as a power struggle between buy side and sell side, the sell side had the upper hand here. They had these companies that they kept private for very long periods of time, which they had time to build, which private market investors bid up through various rounds, who we thought, there was, 6 months ago, every piece would have said that the private markets are the hottest place in the investing world. Now in the public markets are where kind of companies are pawned off onto retail investors. And what you saw with WeWork was actually the public market saying, this thing is just completely illogical. It's not something we can purchase at this price. And the investment banks, which talked about valuing this in their pitches to WeWork at between $50 and $100 billion, and its valuation of $47 billion, SoftBank cut by at least a third, if not more. And I mean, that is something we really haven't seen in the last decade in terms of a rejection of a company of that size that brought it down to earth. And I think that's had a knock-on effect across the board. Several IPOs were pulled, including Endeavor, which was the William Morris talent agency, which had UFC. You had Uber continue to struggle. And what's happened is all these companies that were being sold on growth as the value in it are now being measured for profit. And that's exactly what happens in IPO markets, is when investors say, okay, this growth story stuff is all hype, I need to see actual profits, and these companies are struggling to deliver on that line, and investors are rejecting them. And that's the main thing that's happening here.
Basically, profits are back. They matter.
Profits matter.
Yeah, and we look out at the IPO calendar going forward. Does it look any better, Arash?
Right now, I'd say that, I'm just back from New York. The sentiment is very negative around the market. Everyone is talking about WeWork. And until that dominates the discussion, I think there's going to be a lot of skepticism. So what happens is, what banks do basically to rebuild confidence in the market is they have to give up. So if you're the next batch of companies coming out, the banks will basically advise you to go at lower than you hoped valuations, because they have to give something up now to the buy side. And so that push and pull has to readjust, and it often takes a little bit of time. So the next few companies out in the coming weeks, they're going to have a much lower valuation than they would have been promised 6 to 12 months ago when the banks pitched them.